where people are running into a lot of issues, especially the sort of like the stereotypical crypto bros out there, they don't want to report any of it. There's the subset of crypto zealots who say, no, the government doesn't need to know about this, they can't track it, and it's a bunch of nonsense. But for those people, they're going to get absolutely destroyed as the IRS gets either more guidance from Congress or comes out with their own guidance.
Hey, everybody. Welcome back to another episode of the Richer Geek Podcast. Today, I'm happy to have Micah Fraim. Micah is a crypto and NFT-obsessed CPA. We need some of those, especially in today's world of non-regulation, I should say. But he's also a best-selling author and featured in NASDAQ, Forbes, and Money. How you doing, Micah?
Doing good, man. Thanks for having me.
Absolutely. So, half of us have no idea what crypto and NFTs are. We've had some people, previous guests that have tried to explain it, but you're the first person that's going to talk about tax planning and how CPAs look at this. So give us a little bit about your background and how you got so obsessed with NFTs and crypto.
Yeah, so I'm a CPA. We mostly specialize in tax planning. Historically, it's been for online businesses or other businesses that are really growth centric and have rapidly changing situations, because that's where we can provide the most value. Also, I get bored pretty easily. So the people who have ever changing situations just keep it interesting. And partially as a consequence of a lot of our clients being online businesses and a little more tech forward, they've been interested in crypto, and we'd get questions. And then I got really involved in it a few years ago when there was I'd bought a little bit of crypto in 2017, like everybody did, and the money that the $3,000 I put in turned into $1,000 really fast, and I just mostly forgot about it. And then 2020 rolls around, and a client told two things happened. One, the market had recovered, and that $3,000, that $1,000 had turned back into like somewhere between $6,000 or $9,000. So made me, and at that same time, I had a conversation with a client who told me about a crypto project they were involved in. It was the first time I actually understood the use case for a specific crypto project. Because up until that point, I'd understood that smart people had said, hey, blockchain technology is a huge thing. This is really important. I understood that intelligent people said it was important, but I didn't understand why each specific crypto project would have value. I was like, okay, blockchain has value, but why does this token have value? Anyway, that project was the first time that the use case clicked for me. So I got involved in it really just as an investor and got deeper and deeper into it, and very quickly realized there was next to no tax guidance out there. So we started having to invest it just for our own taxes. We started having to investigate pretty heavily because the IRS has issued very little guidance, and there's very few CPAs and tax attorneys who specialize in this right now, at least.
Now, what are you seeing? Is crypto taxed like a stock, or is it taxed more like a like gold or silver?
Well, it really depends on what type of crypto you're talking about, and it also depends on how you're earning the money. Because if we're going to sort of like super basics, right now at least, crypto is considered property by the IRS, not a security. So that has some benefits and some downsides. One of the benefits of it is that it's not subject to the wash sale rules because it's not a registered security. So the way wash sale rules is that if you buy Apple stock and it goes down in value and you sell it, you can't buy it back for at least 30 days because otherwise they're going to say, okay, you didn't really sell the stock, you just executed this trade to realize the loss on your tax return. They disallow it. Well, since crypto is not a stock right now, at least, you don't have that limitation. So you can sell if you've got your crypto portfolio and you're holding it at a loss, which a lot of people are right now because the market's in the toilet, You can sell your Bitcoin, Ethereum, ADA, whatever, and then buy it back later that day, and you still are realizing that loss. So for regular crypto transactions, like if you're just trading tokens, that's regular capital gains like anything else, except you don't have that wash sale limitation.
Mm-hmm.
But where the IRS is running into a lot of issues is that since this is such an emergent technology, is there's new protocols and new ways that these projects are being created in different use cases all the time, and they haven't addressed the vast majority of them. So most of the new protocols now are what they call proof of stake versus Bitcoin, and up until probably a week ago, Ethereum they were both what they call proof of work. So they're staking now, which is you're sending your tokens to a pool and you receive essentially dividends back as a reward. That's what most of the new tokens are. The IRS has not issued any guidance on staking. They haven't NFTs. They've issued zero guidance on NFTs at this point. They haven't issued guidance on what they call liquidity pools. Like the only things they've actually issued guidance on, I think you can count on one hand. They've said coin for coin trades are taxable. That's easy. They've said that mining income is business income. So if you set up a mining rig and you earn Bitcoin or whatever from it, you treat that the same as you would if you went out and started mowing lawns for your neighbors. They've said you don't have to do foreign bank account reporting on your crypto wallets. They've said you can't do 1031 like kind exchanges. And they've said that airdrops and hard forks are taxable income. And that's it. So if you're involved in crypto at all, you realize that there's new projects and types of projects that are coming out all of the time, and the IRS is years and years behind on issuing any sort of guidance on the vast majority of them.
So what are you doing as a CPA where I dealing and trading crypto or NFT and things come up? Are you just, I mean, I don't want to say you're guessing, but because there's no regulations, but is this something that I could have something happen? You guys do the taxes, and then all of a sudden, whoever's in charge, IRS or whoever in Washington, says, "Hey, wait a minute, this was supposed to happen." Are you going to be seeing like a lot of refiling, you think?
I'm not going to be surprised at all if that happens. I think the main thing for taxpayers is just reporting the income and doing your best job of trying to account for it properly. Because if you do that, given the complete lack of guidance, if the IRS at least sees that you're trying to do it correctly, they should be reasonably merciful if you do end up getting it wrong or the regulations change. Where people are running into a lot of issues, especially the sort of like the stereotypical crypto bros out there, they don't want to report any of it. There's the subset of crypto zealots who say, no, the government doesn't need to know about this, they can't track it, and it's a bunch of nonsense. But for those people, they're going to get absolutely destroyed as the IRS gets either more guidance from Congress or comes out with their own guidance. The AI they're using to kind of track, people to look for discrepancies from what they expect. They're increasingly going to the centralized exchanges and telling them, to get access to their customer data and those transactions. More and more, the people who are kind of skirting the law are just going to get destroyed as the IRS gathers more and more of this information and then focuses that towards enforcement.
And you're saying that now when the IRS goes to these companies, can they be like Apple and say, no, we're not going to give you this person's data? Or are they going to be kind of forced to say, okay, well, here's our database? How do you see that playing out?
Typically, they've been forced. There's one lawsuit. I can't remember the name of the company. I think it's like S Fox or something like that, where they've been it was either the IRS or the SEC that got granted access to the customer data they were requesting. Coinbase a few years ago was compelled to anyone. I think the IRS requested anyone who had over like $20,000 of transactions for that year. that they had to turn all that over. And then they sent out letters to all those taxpayers saying, hey, we think you had crypto activity you didn't report. We need you to report it.
Mm-hmm.
So with all of that in mind, that the IRS is getting better and better all the time at tracking this, the biggest thing is to report the income. Where we come in and where we are try to mitigate that tax bill as much as possible is based on two things. One is that we try and, since there's no guidance out there, we try to find something that's analogous within established tax law for securities and traditional investing or business, because that's usually the two buckets that the income will fall into.
Mm-hmm.
So we try and find, based on established case law, something that we can tie that to, saying, okay, you haven't issued guidance on NFTs or you haven't issued guidance on nodes, but based on the guidance you have for this thing, this is what we think is a reasonable and appropriate tax treatment. And then based on whatever bucket that falls into, then we structure and do regular tax planning the same way we would with those other categories of income.
Mm-hmm. Now, how about is that the same thing with all the the gaming rewards and all that sort of stuff? What are they called? Play to earn. Yeah.
Yeah. So yeah, that's going to be the same thing. The IRS has not issued any explicit guidance on that. So what do we look at? We look at regular games. Mm-hmm. So if you're playing a game, there's a couple different ways that could be taxed. It could just be hobby income, where you go and on the weekend you play in a tournament and you earn $25 or something if you place. Or you could be a professional athlete. You could be a Twitch streamer who happens to just play games. There's different. So if it's hobby income, that falls into its own bucket and has its own rules. The good part of hobby income is that it's not earned income, so it's not subject to Social Security and Medicare. The downside is that if you have any expenses within that game associated with earning those tokens in the play to earn game, you're not allowed to write off expenses for your hobby income. Mm-hmm. So depending on the scope of your activity, that could really bite you in the butt, where you might have $10,000 worth of play to earn rewards, but you spent 9,000 of it just reinvesting it back in the game. Mm-hmm. So that's the first thing we start off with is it business? Is it hobby income? A lot of times, because people are, for good or bad, are using these as investment vehicles, a lot of times it does make sense and it is more appropriate to treat it as business income. Mm-hmm. And when it's business income, then we start to look at, again, the same things we would with regular businesses to see whether or not it makes sense to set it up in some sort of LLC or corporation, to have it elect S Corp or C Corp status. We look at what expenses are available, timing your transactions, all that kind of stuff. So that's the first place we start. One of the things we do warn people with on play to earn games is that, at least right now, every play to earn game that I've seen, or almost every play to earn game that I've seen, they'll have these big spikes in value, and people get in I call them sort of unintentional Ponzi schemes sometimes, because people will buy the NFTs or buy the game items for really cheap, earn money, and then all of a sudden the token explodes and people will be earning stupid amounts of money every day just for playing this game, which it has a snowball effect and attracts more and more people to play the game. And eventually people stop reinvesting, or they start cashing out or whatever, and the game economy just tanks. So far, most of the projects we've looked at have had like a 90 to 99% drop from their peak token price. Mm-hmm. So what we tell people with any type of crypto activity, but especially these play to earn games, is that as you're realizing this income, when you're having taxable events, be that the play to earn rewards being deposited, mining income, node income, executing trades, getting staking rewards, whatever, you need to cash out a certain percentage of that and set it aside in cash so that you're not getting hit really hard when tax time comes. Because what will happen is the IRS is looking at the value of the token when you received it. Mm-hmm. So one game out there is it's called Step In, and it's pretty cool. It's a GPS tracking walking app. So they'll reward you for walking. They'll give you a little bit of crypto every day if you walk. I've seen people who I can't remember the exact token price, but some people were making like $500 a day playing that. But how the token price has gone down, I think that's now closer to like $20 a day. So what you can run into, I'm kind of rambling here, but you can do it to where you're earning $500, and that's a taxable event. You earn $500, $500, $500, and that is taxable as of the price it was at that date. But if you don't cash out and you wait until April 15th comes, you can have it to where your portfolio is worth 1% of what it was, but you still have, so you don't have any money to pay the tax bill, but you've still got all this income that you have to report.
Yeah, it seems like, especially with a lot of the younger people that are playing these games, that there's a lot of education that needs to be taught for them, because they're just having fun and playing and thinking, oh wow, I'm an overnight millionaire all of a sudden. Hey, and oh, then the joke, hey, now I'm not worth anything. And then they can really get in trouble come tax time. I can see that, and it's a great thing you're doing. Now, here's another thing. Now, what if I pay stuff? They have these credit cards that I'm getting advertisements for and things like that are crypto or anything.
Yeah.
How do those things work, and taxes? And I mean, does they even tax the credit card?
Well, that's part of the credit cards are a little. There's only a few actual crypto credit cards out there. So if it's an actual credit, I guess I'll start with a debit card, because a debit card, most of those right now are funding like typical prepaid debit cards. So instead of loading cash onto the card, you're loading your crypto, and then every time you swipe, you're spending your crypto. The problem is that, at least as the law stands now, every time you swipe that card, that's a disposition of an asset, and you've either got a capital gain or a capital loss, which is an absolute logistical nightmare to track your holding period, your cost basis, all of that, especially when you're just going to Starbucks for a cup of coffee or something. I mean, it's brutal. There was some proposed legislation I don't think has moved anywhere yet, where Congress, they were talking about doing it to where if the transaction was under $200, it would be exempt from that reporting, which I think is a great thing. The thing I've said is that they're going to need to put something in there to look at the aggregate number of transactions in a certain time period, because otherwise you're going to have people who are doing $1,199 transactions just to sell
Exactly.
their crypto and avoid the capital gains.
Exactly.
So that's debit cards. Credit cards, just the way they work from an accounting standpoint, is that that's not really the disposition of an asset. That's just racking up a liability. So most of the crypto credit cards, you're not actually spending your crypto, you're just accruing a liability, and they're paying you in crypto rewards instead of points or cash back. So crypto credit cards, at least as they stand now, don't have that same issue, but there's just not that many of them.
Yeah, it's interesting that they might say, well, you can't, you don't have to report $200, but everything else, it's like, I know this whole $600 thing is coming around with regular funds, with banks and all that sort of stuff. So it's going to be interesting to see all the different reportings and all the different, just, to me, it sounds like a nightmare. Well, number one, I don't know what crypto is, and just a bunch of ones and zeros and doing something I don't know. But let's talk about, you have a couple books. Tell me a little bit about the Little Big Small Business book.
Yeah, so we actually, after it happened a little bit after we booked this with you, we actually published another book, and it's specific to crypto taxes. So we've got, it's called Decrypting Crypto Taxes, and the audiobook version and the print version are obviously paid, but we got them for the ebook version we've listed for free on Amazon and most other major retailers. So with that one, what the Little Big Small Business book, that was just general tax and finance and business lessons that we had, and it was mostly tied to some kind of example in popular culture. Decrypting crypto taxes, we kind of designed that just as the FAQs that we would typically get for the questions we were getting from clients, where they say, I've got this kind of income, how is that taxed? So that's how the chapters are designed. Most of them are just framed as questions of, how is my node income taxed? How are airdrops taxed? How are these different things taxed? And then we give advice on how to try to plan and structure around that income based on the regulations as they exist now.
What are you seeing? You know, we're in this bear market. They're calling this the crypto winter. There's a couple things. What are some of the things that you have to really be careful with for when we come next into the next bull run? Which, God, I hope it's sometime soon. Who knows? Maybe after November. Sometimes depending on which way anything goes, things go up and down, and the wars and all that sort of stuff. But what are some of the advice you can tell us about when that next bull run comes and watching your taxes? And
yeah, so during the crypto winter that we're in right now, there's two main things that we'll talk about with people for things they can do right now. One is tax loss harvesting, because again, there's no wash sale rules. So if you've got a portfolio that's underwater, if the loss is at all substantial, it makes a lot of sense to go ahead and execute those trades and realize those losses, so that when the market does turn around, you've got those just held there waiting to be used for when you do have a gain, versus them just being, every time then you start executing trades for a profit, you're having to pay tax on them. So we're banking those losses. The other thing we're talking about is, and you don't always have a choice on this, but certain types of crypto income, you've got a little bit more control over the timing of when the transaction will hit and then when the income is realized, and you have to report it. Normally, when you're in a bull market, you're doing everything you can to defer that income, because you're already making a bunch of money. The last thing you want is to tack on more. So you're trying to push that into a future year. But while we're in this bear market, we're kind of, depending on the type of projects, it can, and your overall income, it can make sense to go ahead and take the hit now and realize some of those transactions when you're in a lower income year. Get the whole, depending on how you're acquiring the token, get your holding period started for capital gains purposes, stuff like that. So that's another thing we're doing during this bear market, is actually accelerating your income while your income is otherwise depressed. When the market turns around, it sounds basic, but the biggest things we talk about are actually tracking and doing tax planning throughout the year, because this is true for crypto. It's true for most types of tax planning. Once the year closes, we lose about 90% of our flexibility. When the year is going on, we've got a lot that we can do to maneuver and try to mitigate your tax bill. But once January hits, that book is mostly closed, and we don't have a lot we can do. So make sure you're tracking it and doing planning on that income. And the other big thing is just making sure that you're taking profits as you go, and at least enough to pay the tax bill that you're generating. Because a lot of the people that we've been having coming to us this year had fantastic 2021s. Had people who were making 6-7 figures, doing astoundingly well, but a lot of them did not cash out at all. They just kept reinvesting in the market, and then the market crashes. So we've had people with high 6-figure tax bills, but because they kept reinvesting in the market, they either just don't have the money at all because it was in some altcoin project that went down 90%, or they're going to have to pay their tax bill. They're going to have to liquidate a large portion of their portfolio, versus if every time they got income from a trade or otherwise, they said, okay, I'm going to cash out 40% of this and shove it into a savings account. That's the people we're talking to who are running into the biggest issues are ones who just didn't do that. And that's a very basic step, but it's one that gets done a lot less than you think it would, because people love crypto so much. It's always going to go up, always going to go up, that they don't want to cash out. But we're seeing the consequences of that with these big ebbs and flows you have.
Yeah, it's interesting. That's where it's a little bit different in the from the market, where I can just keep buying and buying and buying and just build the portfolio. It's very interesting. Micah, I appreciate you coming on. And everybody, we've had a lot of crypto people on, but this is the first time that we've got to talk to a CPA that specializes in it. If our listeners are wanting to find you, Micah, where can they find you?
Easiest way is going to go to our website, which is cryptotaxcpa.com. And we've got some FAQs, general guidance on there, and then obviously just a contact form if you're wanting to talk to us personally.
Sounds great. Well, Micah, thank you very much for coming on the Richer Geek Podcast. Have a great afternoon.
All right, thanks for having me, man.